This is John A.G., and I'm about to show you the most brazen act of market manipulation I have ever documented in my career. They lied to you. U.S. Treasury Secretary Scott Bessent went on Fox News on Saturday, February 8th, 2026, and told the American people that gold is a classical, speculative blow-off. He said prices had gotten a little unruly in China. He told you to be careful. He used every psychological trigger in the book to make you afraid of your own positions. But I have documents here, bank research reports, analyst forecasts, COMEX delivery data, that prove while Scott Bessent was telling you to sell, the biggest banks on Wall Street were quietly setting price targets of $6,000, $6,300, even $6,900 for gold. This wasn't a warning. This was a shakeout. This was a coordinated attack designed to transfer your wealth into their vaults while you were too scared to hold on. Let me read you the exact words. February 8th, 2026, Scott Bessent on Fox News Sunday Morning Futures. The gold move thing. Things have gotten a little unruly in China. They are having to tighten margin requirements. So gold looks to me kind of like a classical, speculative blow-off. A speculative blow-off. Those are the words the United States Treasury Secretary used to describe the gold market on national television. But here's what he didn't tell you. 6 days earlier, February 2nd, 2026, JPMorgan Chase published a research report to their paying clients with a price target of $6,300 per ounce for gold by Q4 2026. $6,300. 3 weeks earlier, January 23rd, 2026, Bank of America told their clients that gold would hit $6,000 by spring 2026 based on the same 300% bull market pattern that's played out in every major gold cycle in history. $6,000. By spring. That's 2 months from now. In January 2026, Deutsche Bank issued targets of $6,000 to $6,900. Societe Generale called $6,000 probably conservative. UBS raised their March target to $6,200. Goldman Sachs is at $5,400. Morgan Stanley has a bull case of $5,700. Every major bank on Wall Street, not some, not most, every major institution, has gold prices significantly higher than today's levels in their official forecasts. And yet the man in charge of America's Treasury Department went on television and told you it's a bubble. Why the difference? Why would Scott Bessent call gold a speculative blow-off, while JPMorgan is betting on $6,300? Because they know something you don't. They know the crash was fake. They know the supply is gone. They know the next leg up is coming. And they want your metal before it happens. By the end of this video, I'm going to show you exactly what they're doing while you're being told to panic. I'm going to show you the COMEX delivery data that proves JPMorgan was backing up the truck at the exact moment Bessent was telling you to run for the exits. I'm going to show you why supply is actually disappearing while prices are supposedly blowing off. And I'm going to prepare you for what happens Monday morning when markets open. Because Monday is coming. They want you to wake up scared. They want you to sell at the open. And I'm going to make sure you don't give them the satisfaction. But first, I need to know who survived this psychological warfare. The government wants you to panic sell. The banks want you to panic sell. The media is amplifying the fear 24/7. Did you fall for it? Pause this video right now. Go to the comments section. I need you to type 2 words, either I held or I sold. Let's show them that this community doesn't fold under pressure. Let's show them that there are people who can read through the manipulation. Comment now. I want to see who the strong hands are. Because here's what they're counting on. They're counting on you to believe the official narrative. They're counting on you to trust the Treasury Secretary more than your own research. They're counting on fear to override logic. Don't let them win. Let me show you the evidence. Let's establish the timeline of this betrayal, because the dates prove this was coordinated. January 29th, 2026. Gold hits an all-time high of $5,594 per ounce. Silver simultaneously trades near $121.64. January 30th, 2026. The crash. Gold drops nearly 10% in one session, the sharpest single-day drop in decades. Silver plummets nearly 30%, wiping out billions in paper wealth. Late January 2026. The CME Group raises silver margin requirements to 20%. Scott Bessent publicly defends this as necessary stabilizing. February 2nd, 2026. JPMorgan publishes their research note. $6,300 gold target. Quote from Gregory Shearer, JPMorgan's head of precious metals strategy. Even with recent volatility, we remain bullish on gold over the medium term. There's a structural trend toward diversification into real assets that will continue driving performance. February 8th, 2026. Scott Bessent goes on Fox News and calls the entire gold move a classical, speculative blowoff driven by unruly Chinese speculators. February 10th, 2026. Bessent doubles down. He extends the bubble language to silver specifically. He blames Chinese leverage. He suggests the worst is yet to come. February 13th, 2026. CNBC runs a feature titled, How China's Unruly Speculators Might Be Fueling Amplifying the Treasury's Blame China narrative. February 14th, 2026. NDTV Profit publishes Gold Price Volatility. Classical, speculative blow-off, cementing Bessent's language as the official media framing. Now let me ask you a simple question. If JPMorgan is so confident in their $6,300 target that they published it on February 2nd, just 3 days after the crash, why is Scott Bessent calling it a bubble 6 days later? Either JPMorgan is wrong and about to lose their clients billions of dollars on a bad call, or Scott Bessent is lying to create a buying opportunity. Which one makes more sense to you? Let me show you what the banks actually said. Not what the Treasury said. What the bank said. Bank of America, January 23, 2026. Chief investment strategist Michael Hartnett and Metals head Michael Widmer published their analysis. They studied the last 4 major gold bull markets in history. On average, those bull markets saw prices rise 300% over 43 months. They applied that same trajectory to the current cycle. Their conclusion, $6,000 gold by spring 2026. That's the most aggressive timeline on all of Wall Street, 1 week before the crash. They also stated that only a 14% rise in investment demand, which was already achieved in late 2025, could push gold to $5,000, and that a credible ETF rotation could take it to $6,000. This wasn't speculative. This was mathematical. They were calculating based on historical precedent and actual demand data. Deutsche Bank, January 2026, $6,000 base case, $6,900 upside case. For the full year 2026. Société Générale, January 2026, $6,000 target, which they called probably conservative. Translation, they think it's going higher. UBS, February 2026, raised their target to $6,200 for March. That's next month. Goldman Sachs, January 22nd, 2026, $5,400 by December 2026, with upside risk. Morgan Stanley, January 2026, $5,700 bull case for second half of 2026. Now, I want you to notice something. These aren't small regional banks or precious metals dealers with a bias. These are the biggest financial institutions on planet Earth. JPMorgan, Bank of America, Goldman Sachs, Deutsche Bank. These are the banks that move trillions of dollars. These are the banks that have entire research departments with PhDs in economics, commodity analysts with decades of experience, and access to data that you and I will never see. And every single one of them is calling for higher gold prices. But Scott Bessent, a political appointee, a Treasury secretary with a background in hedge funds, not commodities, goes on television and tells you it's a bubble. John Finnick, founder of Finnick Consulting, appeared on Kitco News on February 9th and said it perfectly. Let me quote him directly. Anytime Bessent or Powell or anyone in the U.S. government is talking, you have to listen. However, if U.S. banks are on the other side of the trade, you have to wonder why these people are downplaying it. In the past few months, the banks have raised their own target prices. Finnick then listed the evidence. JPMorgan at $6,000 per ounce, Goldman Sachs at $5,400 per ounce, and Bank of America at $6,000 per ounce. And these targets are for the coming months, not the end of the year. He called it exactly what it is, a double cross. On the January 30th crash specifically, Finnick said the sell-off was exacerbated by algorithmic trading rather than a collapse in fundamentals. Translation, the fundamentals never changed. Only the narrative changed. His advice to clients? We are currently in a bull market, and you must buy on dips. And in a separate interview on February 8th, Finnick made an even more damning point about JPMorgan specifically. He said JPMorgan has a history of going after gold and silver on the short side and has been fined billions of dollars for manipulation in metals prices. Then he said this: if they're saying 6,000, that's really bullish, in a contrarian kind of way. Think about that. JPMorgan, the bank with a criminal history of manipulating precious metals markets, is now publicly bullish on gold at $6,300. That's not a casual forecast. That's a signal. They're not warning you. They're telling you where they're positioning. And Scott Bessent is running interference to make sure retail doesn't follow them. This is the definition of market manipulation. The government talks down the price. The banks accumulate at the lows. Then when the next leg up begins, retail is on the sidelines wondering what happened. But it gets worse, because I can show you exactly what JPMorgan was doing while Scott Bessent was talking. Let me take you inside the COMEX vaults, because this is where the crime scene evidence becomes undeniable. January 7th, 2026. Holders of 1,624 January silver contracts stood for delivery on the COMEX. Each contract represents 5,000 ounces of physical silver. That's 8.1 million ounces total. In a normal market, deliveries are spread across multiple banks, multiple dealers, multiple participants, different entities issuing silver to different receivers. That's how commodity exchanges are supposed to function. Not this time. JPMorgan Securities issued 99% of that total. Let me say that again so it sinks in. One bank delivered virtually all the silver. 99%. Not 60%. Not 75%. 99%. That is not normal market activity. That is one entity controlling the entire supply chain on delivery day. And here's the part that proves demand was accelerating, not collapsing. Despite 1,624 contracts being delivered, open interest for January silver futures increased by 1,431 contracts that same day. February silver contracts increased by 1,564 contracts. Translation: buyers weren't getting out. They were getting in. They were rolling positions forward. They were adding exposure because they knew what was coming. During the first week of January alone, 33.45 million ounces of silver were physically withdrawn from COMEX. That represents 26% of registered inventory vanishing in a single week. For the full month of January 2026, 49.4 million ounces of silver were removed from COMEX warehouses. That's over 4 times higher than January 2025. 4 times. Now let's talk about February, because this is where it gets absolutely insane. February 2026 silver futures recorded a massive physical delivery volume of nearly 4,500 contracts, higher than the total open interest before the delivery period even began. In just the first 5 days of February, nearly 19 million ounces of silver were requested for delivery. In just 9 days, the amount of silver delivered equaled the total volume for the entire month of February 2025. Holders of later contracts have been rolling them back into February, such is the concern for availability of the metal. They don't want to wait for March or April. They want their silver now. And JPMorgan? During the crash period, JPMorgan issued 633 February silver contracts and also stopped. That means received 137 contracts. They're both sides of the trade. They're delivering to some people and taking delivery for themselves. They talk down the price on television. Then they back up the truck at the COMEX warehouse. This is the textbook definition of market manipulation. But here's the number that should terrify every paper silver holder on planet Earth. On February 11th, 2026, that's 4 days ago, COMEX depository statistics confirmed that registered silver fell below 100 million ounces for the first time. Specifically, 98,138,005 ounces remain in the registered category. A single-day negative adjustment of 3,256,882 ounces. The eligible category also lost 4.7 million ounces in the same 24-hour period. Meanwhile, open interest stands at about 429 million ounces. Do the math with me. 429 million ounces of paper claims. 98 million ounces of physical metal. That's over a 4 to 1 paper to physical ratio at minimum. Some analysts put the real ratio at 350 to 1 when you account for all synthetic silver contracts. What happens when even 20% of March contract holders stand for delivery? March is historically the biggest silver delivery month of the year. First notice day is February 27th. That's 12 days from now. If just 20% stand for delivery, COMEX is drained. Given January and February demand trends, 20% is on the extremely low side, according to commodity analysts. So let me ask you a question, and I want you to answer honestly in the comments. Do you think it should be legal for banks to issue by ratings and take physical delivery while government officials issue public sell warnings? Is this market management, or is this criminal fraud? Type legal or fraud in the comments. Let's get a record of what this community thinks, because I guarantee you the regulators aren't watching. But history is. While Scott Bessent was calling gold a speculative blow-off, here's what was actually happening in the market. Global gold ETFs attracted a record $19 billion in net inflows in January 2026. That's the strongest monthly inflow ever recorded in the history of gold ETFs. Global gold ETF assets under management surged to an all-time high of $669 billion, up 20% month-on-month. Total global holdings rose by 120 tons to a record 4,145 tons. North America alone added $7 billion in January, the second highest monthly inflow ever, extending to 8 consecutive months of inflows. Asia posted its strongest month ever at $10 billion, accounting for 51% of global net inflows. Global gold market trading volumes surged to an average of $623 billion per day in January. That's a 52% month-on-month increase and 72% above the 2025 average. Does that sound like a bubble popping? Does that sound like speculators fleeing? Or does that sound like the smart money front-running something they know is coming? This is institutional money. This is sovereign wealth funds. This is pension funds. This is family offices. These aren't retail gamblers on Reddit. These are the people who move markets. And they moved $19 billion into gold in January, while Scott Bessent was preparing his Fox News appearance to tell you to get out. Watch what they do, not what they say. Now let me tell you why the banks are buying. Because this isn't about speculation. This is about supply. And supply is disappearing. On February 10th, 2026, Reuters reported that Codelco's Mine, one of the world's largest underground copper operations in Chile, will see reduced output for approximately 5 years. The mine manager, Claudio Sogaret, confirmed projected output for 2026 is 301,000 metric tons of copper. And production will probably remain around that level for the next 5 years, following a fatal collapse that shut down a portion of the mine. The collapse resulted in multiple fatalities, the first such incident at El Teniente in 35 years. Codelco lost approximately 45,000 to 48,000 tons of production in 2025 alone due to the incident. Now you might be asking, what does a copper mine have to do with gold and silver? Everything. Because the banks have satellites. They have geologists. They have intelligence networks that monitor every major mining operation on Earth. And when they see a 5-year production freeze at one of the world's biggest copper producers, they know what that means for silver. Most silver is produced as a byproduct of copper, lead, and zinc mining. When copper production drops, silver production drops. It's that simple. The International Copper Study Group already revised their forecast. They pushed the global copper market from a projected surplus of 209,000 tons to a deficit of 150,000 tons for 2026 because of this single mine. But the silver story is even worse. The Silver Institute released preliminary data on February 10th to 11th, 2026. Here are the numbers. Silver demand outstripped supply by approximately 95 million ounces in 2025. That's the 5th straight year of market deficit. The cumulative 5-year deficit now climbs above 800 million ounces. That's an entire year of global mining output that's just gone. The Silver Institute projects a 6th consecutive deficit in 2026 of approximately 67 million ounces. Physical investment demand for bars and coins is forecast to rise 20% to a 3-year high of 227 million ounces as Western investors enter the market. Industrial demand remains structurally strong due to AI data centers, solar panels, and semiconductors, even as some solar substitution begins. 6 consecutive years of deficits. That's not a cycle. That's a structural problem. And here's the arbitrage that's developing. The Shanghai silver benchmark currently trades at approximately $10 per ounce above Western spot prices. That premium has persisted due to capital controls and logistics friction. China wants silver. China can't get enough silver. And China is willing to pay more than COMEX prices to secure it. So the banks are looking at this data and they're asking themselves, do we believe Scott Bessent when he says it's a bubble? Or do we believe the supply deficit, the COMEX drain, the Shanghai premium, and the ETF inflows? They chose the math. And the math says buy. They aren't buying a bubble. They're buying the last remaining inventory before the shortage goes public. Because when March delivery period hits on February 27th, and if even 20% of contracts stand for delivery, the world is going to find out that COMEX doesn't have the metal. And when that happens, the price isn't going to $6,000. It's going to $10,000. Maybe higher. That's what they know. That's what Scott Bessent is covering up. And that's why they want your metal now before you figure it out. Monday morning is coming. February 16th, 2026. Markets open in less than 24 hours. They want you to wake up scared. They want you to see the headlines. They want you to remember Scott Bessent's words. Speculative blowoff. Unruly speculators. Bubble. They want you to open your brokerage account, look at your gold and silver positions, and think, maybe I should take some profits. Maybe I should reduce my exposure. Maybe the Treasury Secretary knows something I don't. Don't do it. Because here's what's really happening. You are being psychologically manipulated by the most sophisticated financial propaganda machine in human history. The playbook is simple. Step 1. Engineer a crash using margin hikes and algorithmic selling. Done, January 30th. Step 2. Have government officials call it a bubble on national television to reinforce fear. Done, February 8th to 10th. Step 3. Have the media amplify that narrative for a week straight. Done, February 13th to 14th. Step 4. Wait for retail to panic sell on Monday morning. Happening in 24 hours. Step 5. Accumulate the physical metal at suppressed prices while retail liquidates. Already in progress. 98 million ounces left at COMEX. Step 6. Watch the price explode when the shortage becomes obvious. Coming in March. Step 7. Banks hit their $6,000 to $6,300 targets while retail is on the sidelines. Coming in Q2. Q4 2026. You're being played. But you don't have to fall for it. Let me show you the contradiction one more time, because I want this burned into your memory. What they say. Treasury Secretary. Classical speculative blowoff. February 8th to 10th. Treasury Secretary. Unruly Chinese speculators. February 8th. Treasury Secretary. Gold is a bubble. February 10th to 14th. Sammy. Margin hikes needed to cool speculation. January 30th. Media. Bubble narrative amplified everywhere. February 13th to 14th. Official message. Prices are overheated. Sell now what they do. JPMorgan. $6,300 gold target. February 2nd. Bank of America. $6,000 gold by spring 2026. January 23rd. Deutsche Bank. $6,000 to $6,900 gold. January 2026. JPMorgan. Issued 99% of 8.1 million ounces silver delivery. January 7th. Gold ETFs. Record $19 billion inflows in January. COMEX registered silver. Below 100 million ounces. February 11th. Silver Institute. 6th consecutive structural deficit. Actual reality. They're buying watch what they do. Not what they say. The verdict is clear. This is not market management. This is wealth transfer. They are shaking you out to steal your position. So here's my final question, and this is the only question that matters for Monday morning. The government says sell. The banks say buy. Who do you trust more with your financial future? The politicians or the math? Leave your answer in the comments below, because I'll tell you who I trust. I trust supply and demand. I trust 800 million ounces of cumulative deficit. I trust 98 million ounces of registered COMEX silver against 429 million ounces of open interest. I trust record ETF inflows. I trust JPMorgan taking delivery at the bottom. I trust Bank of America's $6,000 forecast. I don't trust a Treasury secretary who goes on Fox News with talking points designed to scare retail investors. Monday morning is your moment of truth. You can believe Scott Bessent and sell into the fear. Or you can believe JPMorgan's $6,300 target and hold through the noise. The banks made their choice. They're buying. What are you going to do? The betrayal is exposed. The trap is set. The contradictions are undeniable. They told you to sell. They told you it was a bubble. They told you Chinese speculators were the problem. But while they were talking, they were buying. While they were warning, they were accumulating. While they were calling it a blow-off, they were issuing $6,000 plus price targets to their clients. This is John A.G. We don't trade the narrative. We trade the truth. The data doesn't lie. The vaults don't lie. The delivery reports don't lie. The market does. And now you know. Don't give them your medal. Don't fall for the fear. Don't sell on Monday morning. Because when March delivery period hits on February 27th, and when the shortage becomes public, and when gold is at $6,000 by spring like Bank of America said, you're going to remember this moment. You're going to remember that they tried to shake you out. And you're going to be glad you held on. This is forensic analysis. This is evidence-based research. This is the truth they don't want you to see. Now you've seen it. What you do next is up to you.